Mark Mobius joins us now. Mark, welcome back. Always a pleasure to have you on ET Now. Thank you for joining us. Mark, it's incredible. It is absolutely incredible the strength markets have exhibited. From a patch of manic depression, this market has made a fantastic comeback. Whatever has been thrown at the market, markets are not reacting. Looks like market are Teflon coated.
Well, in the case of the markets, we're now looking at a wall of money, not a wall of worry. So there's so much money around that it's looking for a home, because with interest rates so low, people don't have much choice but to go into equities, because equities still pay dividends. And sometimes the dividends are better than what they can get in the bank. So that's one of the big reasons why you see this incredible market that we have now. The other reason is that we're facing a V-shaped recovery next year. The virus worries will be over. As you know, they've already found at least one vaccine. They will find others. New treatments for the COVID-19 are being found. So by the beginning of next year, you're going to see a much better environment where people will not be locked down as much as they are now. So there are a lot of things that are moving in the right direction for the markets. Of course, the market is a preview of what we can see in the economy, and it's already told us, because of the good performance, that the economy will be good.
Okay, Mark, the change of guard in America. The Democrats are back. What do you think that will mean for the market? I mean, Democrats are speaking the language of high taxes. So why is Wall Street excited?
Well, my initial opinion regarding Democratic presidency under Biden would not be good for the market, because their program was to increase taxes for the wealthy and for corporations. That, of course, would not be good for the market. However, a number of things have intervened. First of all, the Republicans still have control of the Senate, and the position of the Democrats in the House has been weakened to some extent. So any president to get through a tax bill might have some difficulty. So that is one of the reasons why perhaps the market is now pretty much discounted Biden in that sense. On the other side, the discovery of the vaccine that works is very good for the market. So that's overridden any bad news that Biden might bring to the market.
Mark, the vaccine is coming. Science has triumphed. But there is no deadline. There is a still process in play. It could take 3, 6, 9 months before things start normalizing. Distribution is still a challenge. Do you think markets have run up slightly ahead of themselves in anticipation of how the vaccine would be effective?
Well, first of all, it will not be necessary to vaccinate everyone. In India, as you know, you've got a young population. Most of the young are resistant to the disease, and therefore vaccinations will not be necessary for most of the people. In my case, for example, I'm one of the old people that is more susceptible to the COVID. But even in my case, I'm not too excited about getting a vaccination, because vaccination also carries risks. So the mass of people will not have to have the vaccine. But the mere fact that a vaccine is available places a great psychological upside on the total view of what's happening with the lockdowns. So with a vaccination available, you can stop the lockdowns, and the lockdowns are really what are depressing the economies.
Mark, let's talk about China. China, one or China plus one is the new mantra for most of the corporates now. The boardrooms are insisting that de-risk your risk from China. And IPO has run into trouble. What is your view on China, given that now it's a challenge for China to remain that formidable force in terms of being the back-end factory of the world, and financially also the Chinese companies are getting regulated?
I think both China and India will do very well. With the Biden administration, by the way, relations between the US and China, of course, will get better, and there will be less rhetoric surrounding trade. And you must remember, even under Trump, the China trade surplus has widened. So China really hasn't been hurt that much by the trade restrictions. Of course, India has picked up some of this, and I believe India will continue to benefit from the growth that they've seen and the widening of trade with the US and other countries. But more importantly, the Indian market itself will provide an incredible boost to many of the companies in India itself. So I don't think it's necessary to choose from one or the other. We have to have both. In our portfolio, India is larger than China, but we still have quite a lot in China.
Mark, last time when we spoke, I distinctly remember you said that you've got three Indian stocks in your portfolio. Have you made it 4? Have you kept it at 3, or have you made it 2?
No, we continue to hold the same stocks, and we will continue to look at India very favorably.
Mark, you have option to, invest anywhere because you're a global investor, frankly, who's region agnostic. So what attracts you to India? Is it low oil prices, government reforms, the way we've managed to come back in terms of earnings, and also how the Indian government has handled crisis? What is that unique aspect about India which attracts you to invest more here?
Growth. We project that India will be growing even faster than China the next year. And that's what we're really looking at, because we're starting from a relatively low base. So the growth numbers will look very, very well.
Mark, you understand the classic view of value investing. I mean, there was a point in time you bought 5% in Sesagua. You bought into Reliance also. What is your view on some of these companies which are cheap? Right now, we are going through a phase in the market where technology and internet and digital companies are the real darlings. They are getting expensive on a daily basis, and underperformers are getting cheap on a daily basis. At what point in time do you think the style and the cycle will change in favor of good old value investing?
It's always a good idea to treasure hunt. Go to the things that are unpopular, provided, of course, the companies have strong balance sheets, growing earnings, and have good managements. If they're unpopular, that's the place to be. As you know, the best time to buy stocks is when they are unpopular, when people don't like them, because eventually they will perform very well if those fundamentals are in place.
Mark, having said that, interest rates currently are artificially controlled, which is that right now interest rates are not going to move higher irrespective of where inflation is headed. Now, when interest rates remains artificially controlled, what happens to the concept of PE? Investors would say that when interest rates are down, then you can price P multiples to infinity.
That's a very, very good question, because traditionally we always thought in the eyes of Ben Graham that price earnings ratio was the best measure, or price to book value was another good measure. And now those kinds of measures are pretty much out the window. Now we have to look at growth potential, and we have to look at strong balance sheets, because although interest rates are low now, they may change, and those companies that have weak balance sheets will be in trouble. So the metrics definitely have changed, And I advise people to pay less attention to price earnings ratios, because as you know, with zero interest rates, you can have a PE ratio of 100 times. With even interest rates at 5%, the reciprocal of 5 is 20, you can justify a PE of 20 times. So with interest rates very, very low, the price earnings ratios limits go out the window.
Mark, money has started coming back into emerging markets. So in this reshuffle, would you be betting largely, which way would you lean? Commodity consumers like India and China, or commodity producers like Brazil or Russia?
I think the commodity consumers will do quite well, because commodities, as you know, are down, generally speaking, starting with oil. So that's one of the reasons why India looks pretty good, China looks pretty good. Both India and China, as you know, are big commodity consumers. Commodity producers probably won't do very well. One of the important factors now has to do with ESG, environmental, social, and governance standards. And mining companies, companies that are producing oil, people that are in the commodities business generally have a real challenge as regards to the environment. They're under pressure to improve their environmental standards, and to do so costs money. So this is a big problem for these companies. Eventually they will do fine, I think, but at this stage, I would stay away.
What about the other side of the trade, Mark? You always focus on what to buy, what to trade on the long side. How are you hedging your portfolio? Would you be buying puts? Are you creating short positions? Because you run a long short portfolio, which is that at any point in time, you can also go short.
Put options I would not favor at this stage, because we think that the market looks pretty good and we'll probably see more higher prices going forward. Call options may make sense if you have limited resources and you want to be able to buy stocks that are going to perform well. That might be a good option. But generally speaking, it's always better just to hold the stocks.
You've been quoted, Mark, in global media, and you've been making a case that US tech stocks have made a double top, which means they've topped out for a long period of time. Why is that?
Well, I was already talking about the S&P 500 generally. It looked like a double top as the election was ongoing and the uncertainty was so great. And now what's happened is that the COVID vaccine has stepped in and given a big boost to the market. But at the same time, on the tech side, the tech stocks are not doing very well because of the threat of regulation. As you know, the Chinese have cracked down on the anti-IPO, and they are generally going to increase regulations for these tech stocks. In Europe, they're already after the tech stocks. And in America, I believe antitrust and other actions will take place. So the tech stocks, they're going to continue to survive and do well, but not as well as the other stocks in the market.
I just want to mark the markets for a second here, and you've got Tata Steel, which has really emerged as a big winner. Tata Steel has moved more than 100 rupees in just a matter of 3 or 4 trading sessions. Mark, globally, banks are getting battered. They're completely getting battered left, right, and center. In a low interest rate environment, how does one invest in banks? And given how disruptive the fintech space is, do you think both in India, banks like private banks and private banks like HDFC, Kotak, or even ICICI Bank will not emerge as big outperformers? And globally also, I think the trend is evident if I look at what's happening to Bank of America, Merrill Lynch, or for that matter, JP Morgan.
That's right. And I think for that reason, we're not too excited about the banks. Not until this entire fintech situation is resolved with the banks. At the end of the day, the best solution for the banks would be for them to take over all the fintech operations and fintech companies and integrate that into their own operations. But until that happens, the banks will continue to be under threat. And of course, with this low interest rate environment, as you mentioned, they have to make money on services, fees. And in order to do that, they have to adopt a fintech revolution, so to speak.
So Mark, where would you be happy to allocate disproportionate amount of wealth? What is that one idea from Mark Mobius for this Diwali?
I wouldn't stick to one theme. I think it's important to have a number of themes in any portfolio. You've got to be diversified, regardless of what you're doing. But if you look at our portfolio, for example, you'll see we're heavy in technology. And by the way, when I mention technology, it's in the wider sense. For example, we have companies that are so-called fabless firms that do the IT design for semiconductors. That's the kind of thing we're looking at. But then we also have companies in the consumer area. We have companies in education, in healthcare. So it's good to be diversified.
Fair point. Let's talk about IT, Mark. Indian IT companies have managed to really convert this crisis into an opportunity. The business is growing. Digital adaptation is real, and IT companies are getting a fat pipeline or fat order book also. How would you invest in Indian IT?
Yes, we do. We own IT companies in India, but more on the service side and software side, yes.
Tesla has got a formidable market cap now. Last night news came out that Tesla will be part of S&P 500. Tesla clearly is the most valuable car company. Are markets telling you which way things are moving for the auto industry?
I'm not too excited about the car companies because they're going to come under increasing pressure because of electrification. And those companies that aren't able to rise to that challenge will have problems. The other issue is, of course, what I mentioned, the environmental issue. Even with electric cars, the question is going to come, how about the power to charge those batteries? How is the power produced? In India, as you know, the big source of power is coal, which is highly polluting. So all of these issues are a big challenge for the car companies generally.
Mark, data is indicating that a lot of funds are getting flows in the ESG passive funds, both active and passive ESG funds are moving. What does that mean for global investors? That was the title of your last book also, that how can one invest in ESG? Do you think one should avoid tobacco, liquor, such companies which essentially have a presence in ESG, even coal, thermal power dominated power plants?
Yes, of course. ESG is a big concern for investors. And any investor you talk to, and I'm talking about the large institutional investors in particular, they're very concerned about environmental, social, and governance standards. In the portfolio that we run, we are focusing on governance. So we're engaging with all the companies in our portfolio for them to improve their governance standards, as well as the ESG scoring that they may have, because there's a direct correlation between a good ESG score and the performance of the stock.
So Mark, what are the chances that the next 2 years or next 3 years inflation could actually come back, because so much of liquidity, so much of demand, asset prices moving higher, ultimately it will get captured on inflation? I mean, are we in for a comeback for inflation, or even for that matter hyperinflation?
By the way, I'm just coming out with a new book called The Inflation Myth and the Wonderful World of Deflation. So my belief is that, in fact, we don't have inflation. We have deflation. And the reason for that is technology again. Technology is making things much cheaper and much more available to billions of people around the world. So the generation that we're living in is probably the most exciting of all mankind. We are now in an incredible period of prosperity globally. Yes, there are some people that are poor, that are underprivileged, et cetera, but overall, the world looks very, very good because of technology. So the deflation should be celebrated, not causing any angst.
So would you say, Mark, then, I mean, in this kind of an environment where interest rates are almost zero, bond yields will remain flat, fixed income may be a bad idea to invest in, the only way out is to buy equities, because equities is the only thing which will give you future purchasing power.
Exactly. You've got to be in equities, in companies that are growing, that are adopting technology to the benefit of their shareholders.
And Mark, just to wrap it up with the question which we started with again, this is the most common question which I'm sure you've been asked and which everybody is discussing, is that the naysayers would say it's only liquidity and central bank policy action which is driving markets higher. There is little fundamental push to the current market rally. How would you defend your bullish argument in front of these naysayers?
Well, of course, there are cycles, there are booms and busts, but the long-term shareholder who sticks by stocks and continues to buy when things look bad will always do very well. So that's the important lesson that we've seen over the history of all these markets. The good news is that the long-term trend for stocks is up, not down. And that's something that we must keep in mind.
All right, Mark, really appreciate your time. Season's greeting once again, and certainly hope to see you soon or very soon in India.